Scott, well, so again, thanks for coming in.
Thanks for having me. Glad to be here.
So as Caroline said, we had the pleasure of you being here 5 years ago.
Amazing.
And I have to say too as well, that, I mean, some of the comments that you made, I thought were so interesting that it still comes to mind now. Give us a quick thought on what's changed in the last 5 years.
Yeah, so if we were here at this time in 2019, let's see, what's changed? We had a presidential election. We're about to have another presidential election. So that's changed. No, look, I think the biggest thing that's changed in the environment is, look, we have had a market correction from a valuation perspective, right? So if you basically look at 2009, which is when we started, coming right out of the global financial crisis, until, let's call it, November of 2021, we were basically on a largely monotonically increasing valuation curve over that entire period of time. It's not entirely true, right? Because there was 2016, if you all remember, when Donald Trump got elected the first time, and when Brexit happened in 2016, we had some kind of hiccups in the capital markets. 2018-19, we had the same. Of course, we had this thing called COVID. So it's not that we didn't have any kind of interruptions, but I would say in general, kind of everything was up and to the right. And then, look, the big thing that's changed in the environment is going into 22. Many of you may recall the environment changed meaningfully, right? So NASDAQ was down 36, 37% that year, but basically the unprofitable software index, which is basically kind of the high growth companies, was down like 69% that year. And what it meant for a lot of us in the industry, and maybe for many of you who were in companies at the time, was this idea of growth at all costs really kind of just evaporated effectively overnight, and we now had to grow at some reasonable cost in terms of cash consumption and unit economics and other stuff. So that's probably, I would say, the biggest thing that's changed. The other biggest thing, of course, which I'm sure we can talk about, is or maybe what hasn't changed, is we continue to see just new waves of technological innovation, right? So if you just ignore macro business cycles for a second, what hasn't changed, even from, literally, kind of the early 1970s, is every 10 to 15 years, we tend to have some major technological innovation that basically drives the large, kind of accretion of investment opportunity out here. And so, of course, if you just go back in our recent histories, we had, kind of cloud and AWS. That gave spawn, of course, to the whole software as a service category. 2007, we get the iPhone. 2009, we get the App Store, which gives rise to, the Ubers and Pinterests and, kind of Lyfts and all those things, Airbnbs. And then we get kind of course, obviously now AI obviously is a very investable category. So that's kind of, I think, the constant that, is always the North Star in this business, which is just like the steady progress of technological innovation. And as long as you believe that happens, quite frankly, what I try to do is, look, I think you have to kind of just ignore the macro cycles because, look, they will go up and down. We know that. And they will get too rich at some point and they will get too depressed at another point. But what really matters is, are we making steady progress on the technological side?
Yeah, great. Well, I think all of you can already tell in that first 2-minute intro, Scott's not like a lot of the other investors that we've had here for these chats. Not only is he going to be able to talk articulately about that investment process, but he also has a macro view. I think the first time I heard you speak, you were already calling out what was happening on the NASDAQ, the fact that companies were staying private for a whole lot longer. How has that evolved? I mean, obviously the markets have been closed these last 3-4 years for a host of reasons, but do you see that trend changing?
So I think the basic trend is still consistent with what maybe you heard me talk about many years ago, which is if you look historically at data, basically kind of from the 1970s until the early 2000s, most venture-backed companies went public between 5 and 6 years after starting, and the size of those companies was very small. So kind of at its low point, these were companies that were doing $15-20 million in annual revenue. And look, we can debate whether that was good or not, but certainly, that's dramatically changed. If you look where we are today, we're kind of 10 to 12 years on average for most venture-backed startup companies. Many of them have, hundreds, if not in some cases, obviously billions of dollars. And I think, I won't bore people with how we got there, but I would say the very quick summary of how we got there is it's very hard generally in our public markets to be a small cap company. There's one big exception to that, which is the biotech industry, for those of you who do life sciences. But in general, if you are not in biotech, it's very hard to sustain a public company that probably, I would argue, doesn't have close to at least a $5 billion market capitalization these days. And there's lots of reasons for that, but the basic simple reason is, look, mutual funds are big, hedge funds are big, investment banks are big. It's very uneconomical for them to trade stocks that are basically relatively, that they just don't have very high volume of trading and don't have lots of liquidity around them. And that's often what happens kind of in these smaller cap stocks. So I think the trend hasn't changed at all. I think, I was talking to an LP this morning about this. I don't think we're going from 5 to 6 to 10 to 12 to 20 basically. I do think there are a couple natural forcing functions that prohibit us from getting there. I think one is still employee liquidity. And there's some companies, but there's very few. There are the Stripes of the world or the SpaceX of the world who can do employee liquidity programs that can kind of release the tension for employees to get some partial liquidity. But to be completely honest, I think that number of companies is a very small number of companies. And then the other thing I think that still drives companies is it's still much easier to do acquisitions, to do M&A activity as a public company. It's still hard to do private acquisitions because you're constantly fighting about whether your valuation is real or stale or what happens. So I think we're not going backwards to 5 to 6, but I think we're probably at stasis somewhere in the 10 or 12 range.
Interesting. I've also heard it said, I'm not going to point at any fingers, but I've heard it said that mega funds like Andreessen have enabled these companies to stay private for a lot longer. How true do you think that is? And do you want to fix it? Do you want to see a world where we stabilize at 10?
Yeah, it's a great question. So I would argue that if you look at the data, this trend towards longer, staying private longer, actually predated the rise of, I'll use your term, mega funds. It predated that. I think what actually happened is, my personal view, I think is what happened, and I think the data bears out with this, is there are some companies who kind of decided to stay private longer, along with other companies, of course, where we've had governance changes. So I don't want to blame it all on Mark Zuckerberg, but I would say there was this offshoot of what Mark Zuckerberg did, which was change the governance structure, change the board composition. And again, we can debate whether those are good or not, but I think they're undeniable that they happened. And along with that, also ended up staying private longer. I think what happened is the money basically followed those trends, basically. And so the initial money that came in was mutual funds coming from the public markets into the private markets. The next money that came in, of course, was the hedge funds. Many of us, of course, know about Tiger Global and stuff like that. And then I think what happened, my personal view at least, I can tell you what happened inside of a16z is we said, wait a second, why are we ceding that territory to folks like that, right? So we know these companies, we've been on the board with them from very early on. We feel like we have unique insights into their business. We think there is an opportunity for significant appreciation. Why shouldn't we follow these companies longer than we have? So I would argue, let me take the counter, which is, if we just disappeared or other mega firms disappeared, I'm not convinced that other money wouldn't still support this activity. To your question about what do we want? Look, we clearly want our companies to be public companies. There's no question about that. And so, this idea of perpetually private companies, I just don't think is going to exist or work in this business. This is a cop-out maybe to your question, but I think companies should go public at the time that is right for them to go public. I think what we are seeing now is, as much as it can be a mistake sometimes to go early, it can also be a mistake to go too late, right? So these are product cycle-based businesses, right? And the danger of being too late for going public is you end up with declining kind of revenues or declining growth rates in revenues. And now as a public company, you have to kind of catch the next product wave. We know that's a lot easier to do, obviously, as a private company. So I think we've seen some companies that kind of just have mistimed things in a way that kind of where longer is not necessarily better.
I love that answer. I learned a lot just in that little piece right there. But I want to be sensitive to the fact that if I had my say, we would go inside baseball and venture for the whole hour. But I think a lot of our folks, they want to hear from the founder perspective. I'm going to pull it back a little bit. One more thing that's changed since 5 years ago is that your fund has increased by quite a bit. I think even back then it was already in that first tier. But since then it really stands, if not alone, certainly in the top 2 or 3 in terms of size and brand. Can you say a little bit about, is that how you see it? And can you also say a little bit about how you guys got there? What is it that's allowed you to win in this ultra competitive space?
Yeah. All right. So, look, I feel very good about where we are competitively, and I don't mean that to be rude or arrogant or anything. But look, I think we benefited a lot from a couple things. Number one, look, there's no question we benefited from being in a bull market, right? So we started the firm in '09. It was a contrarian idea to start a venture capital firm in 2009, right? So for those of you, again, who remember your history, we have 2008, like the start of the global financial crisis. Bear Stearns goes bankrupt in March of 2008. Lehman Brothers goes bankrupt in March of 2009. We have obviously what looks like kind of the end of the world in terms of kind of, major economic growth. So we were lucky. Look, I think we had a great story, but we were lucky to be able to raise a fund in 2009. I would say we were also lucky, and this was where luck played it to our benefit, was we were lucky to be a new firm in 2009 because what we didn't have was all the legacy portfolio companies that all the existing venture capital firms had to worry about. So you've heard me say this before, but I always pitch this. If you're bored tonight watching election returns and you want something else to do, go Google Sequoia RIP presentation from 2008. And what you'll see is this 75, 100-page PowerPoint presentation that Sequoia gave to all their portfolio companies. And it's RIP because literally it had a skull and a crossbone and a tombstones on the front, and it said rest in peace. And basically they said, look, like, you will never raise another dollar again. The world is coming to an end. Put all your money under your mattress. Like, this is it. Like, go kiss your kids goodbye, basically. And look, I mean, I say that part joking. It was a common thing at the time. The implication for that for the venture industry meant that if you were an existing venture firm in 2009 when we started, 99.9% of your energy and effort was devoted towards, kind of salvaging your existing portfolio companies. And we had the beautiful luck, and it's not. We did decide to raise money in the global financial crisis, but we didn't say, okay, let's opine a global financial crisis so that we can raise money, basically. But we had none of that, right? So what the benefit that we had was we were this nice shining, gold, coin on the hill or something, and we could say basically, look, we are open for business, and we don't have any of these portfolio companies. So if you are an entrepreneur in 2009 and you are excited about starting a company, maybe we were the only game in town, quite frankly, to a certain extent. So I bring that up not to say, that's always a good strategy, but I would say, look, what that illustrates is, look, there's always an element of strategy and planning, and then there's always elements of timing, right? Mark Andreessen has said this many times, and I think he's right, which is there's not necessarily any bad ideas that could be venture-backed companies, but there is often bad timing. And we experienced it personally as entrepreneurs, right? We started this company called LoudCloud in 1999, which was basically we were trying to be what is now Amazon Web Services, and it turned out we were just too early, and it just wasn't the right time. Or again, for any of you who are old enough to remember, Webvan, kind of Instacart 20 years later became the successful Webvan that couldn't exist in 99, or Chewy.com became the successful Pets.com that couldn't exist in 99. So anyways, luck and timing, of course, plays a big role in all this stuff. So I guess to your question of kind of what's happened and what's changed over time, I think the biggest thing that we have benefited from is we now have a track record, which we just didn't have, right? So in '09, when we started the business, the way venture capital firms competed against one another was, they basically competed by, saying, hey, we have backed these various great companies. Don't you want us to back you? I mentioned Sequoia in this context out of deep respect because they're an incredibly great firm. If you go to the Sequoia conference rooms, you will find posters of all the companies that they backed before, right? So you'll see Cisco and Apple and all kinds of other stuff in there. And to their credit, they did that. When we started in '09, we didn't have any of that. So part of also what we did, which worked out well, was we had to change the basis of competition in this industry. The basis of competition previously was I funded Apple, I funded Cisco, I funded Microsoft, therefore you should want me to fund you. Again, in the absence of that, we basically had to say, look, our differentiation is going to be, we are going to kind of, talk about building a firm that is founder first, that kind of, is started by founders, that kind of understands the founder journey. And then, we had to kind of, help the industry kind of change the marketing to there. I mean, I would argue, if you look back now 15 years, I think much more of the industry now has kind of shifted its marketing there. And that just means, obviously, we have to run faster and harder, certainly, than before. But I would say that's kind of the big thing that we benefited from, was kind of being able to kind of change the marketing-based mindset of how entrepreneurs thought about venture capital.
Yeah, I think for a lot of the founders that I've talked to in the last 10 years, if they think about you guys, that's the first term that comes to mind. It is that service, it's the additional investments that you guys made on all that. But to your point, it does feel like the rest of venture is starting to catch up. do you still think that that's where you want to invest your time and your resources, try to advance in terms of, here's your chance to pitch all of the founders in the room, right? When they get a term sheet from you, but they also get a competing one, why should they pick you guys?
Yeah, so let me start at the very highest level, which is, look, the fundamental question any of us who sits on this side of the table have to ask every day is, what do we do differently that is of value to an entrepreneur? And I bring that up to say, look, like again, the nature of this business has changed a lot, which is there was a time where the value that venture capitalists brought was capital. Like capital was scarce, the VCs had the money, and that was really the derivation of the power of venture capitalists. And that's, again, not an indictment of the industry, but that's a lot of how the industry worked from early 1970s kind of into mid-2000s. When we got to the point, particularly, I think it's very hard to kind of overstate the significance of Amazon Web Services and cloud computing generally, right? When you get to the point where you don't need to raise venture capital money to do what we did at LoudCloud, which is buy Sun servers and Oracle databases and Cisco networking equipment and EMC storage equipment, but you can rent that. You now convert what was a multi-million-dollar initial investment into hopefully a couple $100,000 investment. Some of you may know Mike Maples from Floodgate, a really fantastic firm. When Mike started his firm in, I think, 07 or 08, his mantra was $500,000 is the new $5 million, basically, right? And what he meant was, with the advent of cloud computing, we don't need a $5 million investment anymore. We can do a $500,000 investment. And so I think that has just totally changed the nature of this business, which is we need to do two things as venture capitalists. It used to be you just had to be smart to pick a great company. Now you have to pick a great company and you have to win the right to fund that company, basically. And so I say that humbly in front of a bunch of entrepreneurs, which is, look, I know raising capital is hard, and I certainly don't want to minimize that at all, but I would say relative to kind of how the industry has evolved over time, like the entrepreneur is in a much more privileged position, I think, in terms of capital raising than certainly you were 15 years ago. So I think that's kind of what's changed in the industry over time. What does it mean for all of us? Like, look, we've taken an approach where, as John said, like we have what we call a bunch of operating teams that kind of help our companies on sales and business development and policy and regulatory and marketing and all kinds of stuff. And it's big now. We have over 300 people in those teams out of a firm that's like 550 people. And look, that's the model. That's the way we've decided to exercise that. But look, that's not the only way to do it, and there's lots of other firms out there who do things differently. But I think the fundamental question that we always have to ask ourselves is, how do we earn the right to be able to hopefully convince you that we should be your right partner? And so for any of you who are raising capital out there, I would just ask you should ask the same question in reverse, which is, okay, like, what is it that this venture capital firm or partner or person brings to me? And look, maybe the answer is you don't want anything, and that's okay too. Like maybe you're like, look, I know everything, that's totally fine, and the reality is all I want is a check. I would argue, I think, like you might be, cutting yourself short by doing that. But ultimately, I think that's the fundamental question to ask is like, what do I think would be valuable to help me achieve my dreams as a founder? And do I think this individual or this firm or this set of people can help me get there? And if you think we can do that, great. If you don't think we can do that, then like go to the next person, down the street.
That's an interesting point. I would love to hear you go, because you're in that top-down view where you have that management day-to-day view of what happens at your firm. Can you say a little bit more? I heard you just say that of the 550 employees that you guys have, roughly 300 are on the
operating team side.
On the operating side.
Yeah.
Is the rest of it on the investment side, and what's the breakdown between early stage and growth? Or how do you think about where people fit?
Yeah, so the big functions inside our firm are, you've got investing teams, you have these operating teams, which I mentioned, and then look, for a firm of our scale, so we're managing, $40+ billion in assets today. Look, we have a functioning company, right? So, we have HR people and legal people and compliance and, finance and, all the other things you'd expect to have. So I'm not sure I can tell you the exact numbers, but I would say roughly, let's call it like 300-ish in the operating teams. I would say probably 100-ish or so on the investing side, and then probably 100-ish on, let's call it broader, how do you run the firm?
Okay.
Essentially.
On the investment side.
Yeah, on the investment side, the vast majority of resources are on the early stage side. So we have basically 7 different early stage funds that map to different verticals. So everything from life sciences and healthcare to gaming to what we call American dynamism, which is kind of, think of that as like national defense and public safety and space and energy and things like that. And so we decided very importantly for us from an organizational perspective that you should think of each of those early stage funds as basically their own business units inside of a16z, okay? So just like in a big company, right, you often have like a general manager of a business unit. These are basically business units, and what I mean by that is they have full responsibility for all investment decision making, and they have full responsibility for all budget and kind of operational headcount decisions, right? So if I'm Andrew Chen and I'm running our games fund, not only kind of am I accountable on the investment side, but also if I decide, hey, look, you know what, I need to hire more sales and marketing experts to help my companies get better penetration with the studios, and I think I need maybe less people on the talent side to help them hire engineers, like that's my decision as Andrew Chen running that thing. So you should think of them as business units that are accountable. They have a budget they're accountable to, and then of course, obviously, they're ultimately accountable to the investment returns. So and then on the growth side, growth is a single fund that is not bifurcated by industry. Now, each of us has different areas that we focus on within the growth fund, but we just raised a new growth fund that's like $3.5 billion or something. We probably have 10 or 15 investment people or something on that compared to, let's call it 85 plus that are on the kind of early stage side. And that's a lot because, look, we get an enormous amount of leverage from our early stage teams, right? So we don't need to replicate all the like domain expertise in every domain that we do because we have a great partnership with our early stage teams. So that is a much more highly leveraged opportunity to have a growth fund like that and have many fewer people who can obviously benefit from the infrastructure we have at the early stage.
Got it. Is the growth fund exclusively investing in the follow-on rounds for your early stage?
No, the growth fund has the charter to be able to do anything that is basically at what we call growth stage, which is a highly nebulous term that doesn't really mean anything. But basically think of it as like the way we've affected it is mostly it means it's really hard in a multi-billion-dollar fund to do stuff that's less than $50 or $75 million of investment, and we can probably do up to like $350 or $400 million investments. And in general, it's supposed to be where we're not really taking product market risk, fit risk at this point. We really are saying, okay, great, we've got a company that's doing 10, 20, $30 million. How can we help them get to $100 million or $250 million? That's kind of generally the charter. Now, of course, we do some life sciences stuff, obviously, where there's exceptions to that. But in general, that's the charter. If you look historically over time, about 60% to 2/3 of what we do comes from inside the portfolio. So it's us having done Databricks at an early round, getting really excited about it and saying, hey, like, we just want to keep doubling and tripling down on it. Or, we've done, Flock Safety as a company in the safety space. So we've done a lot of that, roughly about 60% to 2/3 of it. The other stuff that we do that is technically outside the fund, outside the early stage, the honest answer is 90+% of that is stuff that we have seen and tracked at some point in time, often through our early stage teams, that for whatever reason we didn't do. And maybe it was a mistake, or maybe it was the right answer at the time to do it, and it turned out it's broken out. But it's not what we're not really typically doing is saying, hey, like, let's go look under some rock here and there for some company that we've never heard of before. That is whatever, some generational transition opportunity or something like that. Most of what we do, we call it actually late stage venture is what the name of the fund is. And it really is that, which is, look, it's venture-backed companies, most of which hopefully we have seen and tracked over time. And, in that case, it's like, okay, we missed it for whatever reason at the early stage. We still think there's a significant appreciation opportunity. Let's now kind of be able to kind of, invest alongside those founders.
Got it. Well, I learned something new again today because I was actually not aware. Of course, I'm aware of the existence of teams, but I guess I hadn't really thought of them as these, not independent, but somewhat pseudo-independent views. How high are the walls between each one? And for a founder that, for example, knows a partner at Andreessen, but is in the wrong team, is that still the best point of contact, or should he or she redirect and really get to the right team?
It's a great question. So let me take a step back and just tell you why we did what we did, which is, having looked at venture firms in our view for a long period of time, we think that scale often is the enemy of returns in venture capital firms, right? Okay, so it is often the case that obviously as you increase AUM, returns degrade. Now, therefore there's a simplistic meme which is, okay, like big funds are bad, small funds are good. Our view of the world, and obviously time will tell whether we're right, is there's specific behaviors that happen in the organizational perspective of most firms that causes them to degrade as things scale. There's no law of nature that says like a big fund is bad. And our view is what happens typically in these firms is they keep too much stuff centralized, is the very simple way to describe it. And what I mean by that is, okay, I'll take Andreessen Horowitz. Mark, Ben, and I have been there for a long time. Therefore, in the traditional venture structure, we would get elevated to like we should be the Uber investment committee for all these other vehicles, and we're smarter, we're all knowing, so we should make all the decisions, and everybody should have to come prostrate themselves in front of us and, kind of tell us, get our permission to do stuff. And I'm exaggerating a little bit for effect, but there are some examples of that in firms. And so we think that degrades decision making because what happens is people confuse seniority with domain expertise. And at the end of the day, particularly for early stage, our view is the only way you win in early stage is you have to have super deep domain expertise. So we're lucky to have a guy, Martin Casado, who runs our infrastructure side of our practice. And his team and he are deep computer science experts who understand everything, who literally can do code reviews. They need to do code reviews. And there's no way that I can go look at a deal they propose to me at an investment committee and opine on whether they should do it or not. It's just not possible. They live and breathe. They know the 50 companies who are doing, character-based AI, whatever they're doing, right? And I can pretend I understand that from a memo they send me, but the reality is I don't. So our basic MO as the firm is we said, look, the only way we think you can scale without degrading the firm is you have to get to massive specialization and you have to get to delegation of responsibility at the level where people who understand this stuff. So as an example, we do not have an investment committee at the central firm. So there is no central investment committee. The only investments decisions are made at those individual fund levels. And if I'm participating at the level that I can add value, then I'd be part of it. But I do a lot of stuff in the biohealth side. So I go to their investment committees and talk to stuff about them, but I'm not a decision maker because I don't have the same level of expertise in the early stages they do. So anyway, so that's why we did it. So to your question then about what you do now, the other thing to remember is, look, you asked about how the walls are. One of my partners, David Haber, always says that kind of really interesting opportunities happen at the intersection of verticals, right? So, and we see this already, right? There are lots of intersections of financial services and crypto, or gaming and crypto, or even health and other, applications, right? Consumerization of healthcare. So we have designed a model where basically everybody has compensation that is both tied to the particular vertical they're in, but then also they have exposure to everything else in the fund. Rough way to think about it, 2/3 of your carry-based compensation is attached to your fund that you're primarily responsible with, and 1/3 is attached to everything else in the firm. So we did that because we want to encourage people to kind of, work across the aisle where they can. So I will finally answer your question, which is, look, if you are looking to get into a16z, I would hope, and I may be wrong, but I would hope that everybody is incented to work as a team. And so if you are in the wrong spot and you need to get pushed over to another place, that's great. If you are in one of these intersections where both make sense, there are some times where partners from two funds will work on a deal, and maybe we end up literally splitting the deal in terms of investments between funds. Sometimes we just put it in one fund, but we know we're going to tag team on it. We'll kind of figure out what makes sense. But I would say, as a general rule, it is good to get to the place in a firm where the partner who's evaluating your deal has the right specialization and focus. I get 1 million, as you can imagine, inbounds all the time from people. In fact, I know sometimes you send me stuff, and my response is, great, thank you. I'm going to get this to the right person, and they're going to tell me whether it makes sense or not, because for me to try to opine on it is just a waste of everyone's time.
Yeah, I'm going to find some time with you to brainstorm about how I should get my leads to you guys. But independent of that, let's talk about a topic I hear our founders spending a lot of time thinking about, which is the associate versus partner accountation. I'm sure you have thoughts on this. My sense is that each fund is a little bit different. For Andreessen, how empowered are the associates? How empowered are the partners?
Yeah, so for us, look, we make it hard for people because we often use the name partner for everybody. That goes way back, and I won't bore you with the details on that one. But look, there's no question, as you all know in your organizations, right? There are some people who are ultimate decision makers, and there are some people who contribute to the making of a decision, right? But they may not ultimately, kind of have definitive authority. Look, venture capital firms are the same way. So yes, we have our definition of a general partner is you can write a check and you can sit on a board. That is what a general partner means. But we do have, we don't often use the words, but we have the equivalent of principals and, associates and analysts and all that other stuff. They are enormously, enormously valuable and impactful. I think of them as, look, they are a massive augmentation of everybody's eyes and ears about what's happening in the industry. And so number one, I would say the same thing to them, but you should not engage, at least at a16z, and I think this is true more generally, like you should not engage with a partner or associate or somebody, even though they're not the general partner on things. Like the reality is often stuff that shows up on the desk of a general partner often is sourced by an associate or an analyst. And then even if they didn't source it, like they are an enormous part in our firm of helping with diligence, and we want them to give us their point of view on stuff. And there's no question there have been times where they've given us feedback on things where we're like, yeah, okay, we're going to do that, or we're not going to do it based on feedback from that. We actually we invested in Pinterest, luckily at the Series B, and initially the partner who was sponsoring it, Jeff Jordan, was not convinced of it, and at the time we had a woman named Connie Chan who was not a GP at the time. She was actually, we didn't use the word, but she was effectively like an associate. And she like pounded the table on it and helped him understand it. And luckily for us, like we were not too stupid to listen to her at the end of the day, and we made the right decision. But so I think it's really important. What is important though, I think is, look, like if you are working with a venture capital firm or you are pitching a venture capital firm, just like any other sales process, you have to understand the nature of that sales process, right? So it's just like when I'm calling on an LP, for example, I have to understand, okay, who are the decision makers? Who are the people who might be champions but can't be decision makers? Who actually has the budget? Like, what is the process? So like, what do I have to do ultimately to get to a yes? Or what are the gates or the milestones and stuff like that? And so look, I just think you should, I would never like ignore anybody in that process, but I do think it's also incumbent upon you to kind of have that conversation. And it's not a rude conversation, just say, great, like, sounds like you and I are having a good conversation. Sounds like maybe you're interested. Like, what is the process? Like, what happens from here? Like, what do I need to do, in order for you all to get to a decision? And I think it's a really important skill to have, period, as the CEO of a company, because everything you do effectively is an enterprise sales process. And I would just think of, fundraising as, pretty much that exact thing.
I think that is such an important point that I hope all of the founders in the room are really, really going to think a lot about and really imprint upon, because I could not agree more. I think the frustration that comes out usually comes from a place of, I had 3 conversations with someone, his or her business card said that they were an investor at some fund. I thought that meant something, but then it went away, right? So it's, to some degree, we could argue it's up to the VC to educate you.
Look, I agree. Bad on that individual for not doing that, but also I would say, look, like it's your responsibility to control the process, right? It is a process. Now, look, I can tell you, because we're doing the same thing on the other side, which is we're saying, okay, gee, who else are they talking to? What other firms are in the mix here? And as we get more and more excited, okay, like, what do we need to do to make sure that we kind of communicate our process clearly and get ourselves in the pole position to win the deal, right? So, but I would just say, like, don't abdicate that responsibility. This is not a denigrating thing about an associate, but don't abdicate that responsibility to an associate, but use that associate in a way that helps you understand the steps and the milestones and how to get there. And yes, like, I would hope our associates don't hide the ball on that stuff, and if they do, obviously, then look, you have to figure out how to escalate or get around them. But in general, I would say, like, deciding to have a conversation or not have a conversation with someone based on their title, I think is a mistake, as long as you understand ultimately what the finish line and getting to the finish line looks like.
All right, I'm going to ask 2 more questions, and then I'm going to turn over to Q&A, folks. So please think about
your questions. Scott, you made a great point about
how cloud transformed venture, right? The fact that now that first round could be substantially less. A lot of people seem to think that AI is going to do exactly the same thing. The headcount that you need, the amount that you need to invest into sales, marketing, dramatically changed. What do you think is going to change in venture for our founders because of that?
Yeah, so I think that's a good analogy, right? So basically, you're right. Essentially, what cloud did was it changed capital expenditures into operating expenses and dramatically reduced the barrier, right? So again, as I said, like 500,000 is the new 5 million, basically, right? So like we took what was a $5 million requirement to just get yourself into business, and maybe it's not 500,000, but whatever. It's an order of magnitude lower, right? Because you can leverage, but through operating expense, some infrastructure somebody's already built. Look, I think AI is good. So I think that's right. Look, if you just forget all the hype and all the excitement around AI, of which, like, we believe, just think about AI as, in very simple terms, a massive productivity enhancing set of technologies, right? And so, yes, like, I don't know exactly how to translate it yet, but there's no question that if you're starting a startup today, even if you're not an AI company, like I guarantee you, your developers are going to use some form of Copilot to help themselves get more efficient on developing their code, and certainly your sales teams and your customer support teams and everybody else. So if you just think about all the functions in the organization, yes, like those should all have some. We don't know yet what the number is, but they should have some material degree of like productivity enhancement or disinflation, whatever you want to call it. And so yes, I think you could argue then maybe 500,000, I don't know, maybe 250,000 becomes the new 500,000 or something like that. Look, I think that's exactly right. And I think that's a hugely positive thing, right? If you look at the numbers of startups that started as a result of this change from 500,000 being the new 5 million, like it's gone, any numbers you look at, it's gone up by 8-fold, 10-fold. I don't know what the numbers are, and so like anything that we can do to lower the barriers to starting a company and unlock innovation is great for our society, basically. So I think that's entirely the case. I'm not convinced yet, and maybe I'm just a Luddite, I'm not convinced that we're going to have these magical 2- and 5-person companies that can get to $1 billion in revenue because of AI. Now, maybe there is something out there, and again, we all know, like obviously whatever, Instagram famously had like 7 or 8 people when it was bought for $1 billion by Facebook, and WhatsApp, of course, had like some crazy, insane small amount of numbers. So there will be some examples of that, but I do think what it will cause us to do is it's just going to cause us to rethink all the elements of things we do and figure out ways that we can increase productivity. The big question will be is, look, if you are still an enterprise company and you are selling to other enterprises, does AI dramatically transform the sales and marketing expense for your business, or are we talking at the margin, it just helps increase productivity? TBD, I guess, is the answer, right? So like if you could solve that problem, then yes, like you could massively shrink the amount of capital that people need. And maybe that will happen. I don't think we're there yet, right? I think we're at the point now where it's incumbent upon everybody to think about how can I use elements of AI in every of my operating functions to make my business more efficient. And then hopefully we get 10% more efficient, and then we're like, great, now we can get 20% more efficient, and we keep turning the crank. So I'm a massive, massive believer, and this is why, look, personally, like I'm hugely optimistic about, from a macro perspective, about the economy, is like, we haven't had the potential for an unlock in productivity growth like this in a long, long time, basically, right? You could argue maybe since we had effectively like, kind of the client server revolution and stuff like that. And so if it plays out the way it does, look, I think hopefully this kind of malaise of like, it's really impossible for us to actually grow GDP more than 1 or 2%. Hopefully we can get to a point where you can actually grow GDP at levels that, are much more exciting because we've really solved the principal bottleneck to GDP growth, which is effectively productivity.
Interesting. Well, there's an interesting trend here, right? I mean, you go back to 2000, and as you said, that first round had to be 5 million, and then maybe 8 years later, because of cloud, that's dropped by a factor of 10, and maybe now it's dropped by a factor of 2. At the same time, seed rounds have grown dramatically in size, right? I mean, the earliest institutional round that you raise now is $3 million, $5 million. Yeah. So there's a weird conflict there.
Right. I think you're right. So I don't know if this is a satisfactory explanation, but so I do think you're right, which is for institutional capital, you're absolutely right. We've had, maybe the equivalent is we're at an academic institution, the equivalent of grade inflation, right? Which is like, what used to be a seed, we now call, what we now call a seed used to be what we called an A. So it's, I don't know, maybe that's reverse grade inflation. I don't know what the right term is. So I think that's right. So my best argument for why that is I still think it's the case that, look, the absolute quantum of capital that you need to raise at the very early stages is clearly lower because of the things we talked about. At the same time, what I think has happened, and not to talk our own book here, but I do think kind of software continues to eat the world in a way where the scale and the scope of successful technology companies just can be dramatically bigger, right? So for all of us in this room, I'll raise my hand too. Like, I don't believe no one ever thought we'd talk about $2 or $3 trillion market cap technology companies. Look, and we can argue whether we think NVIDIA is overvalued or Microsoft's overvalued, but the reality is, like, just forget about what the market capitalization is. Like, these are businesses that are doing, tens of hundreds of billions of dollars of revenue and operating profit. Like that just didn't exist right before. So, and at the same time, again, I would argue that like the opportunity from a global perspective is also, just dramatically different, right? Like, so you all know this probably, but 25 years ago, the US was 90% of global venture capital. Today, the US is just barely 50% of global venture capital. Now, don't cry too much for the US. I mean, obviously the pie has gotten a lot bigger, so the nominal dollars are huge, but What that says, though, is the accessibility of technology into markets that were previously potentially less accessible before has also gotten bigger. So, I think you've got this weird dichotomy, which is, you're right, is it's probably cheaper than it's ever been to start a company. It's probably, today at least, also more expensive than it's ever been to scale a company. And I think that also explains why you have firms like us who have these larger funds over time. And look, maybe we're all telling ourselves stories, and that's all not true, but at least I just think the opportunity set for a successful technology company is now, we take these numbers, with a grain of salt right now. But look, we never thought of technology companies worth, if we all had, like, the whole unicorn thing, right? We all thought a unicorn, $1 billion was amazing, and it is. By the way, I'm not trying to denigrate it, but that's tiny compared to, whatever, a Stripe or a Databricks or, any of these like world-changing companies. Or look at OpenAI, and look, maybe again we can all debate whether there's overvaluation or undervaluation, but there is some confluence of people who believe these can be $1 trillion opportunities, and that's just a total change in mindset.
Fascinating world. And I think there's another note here for our founders. I think it's a lot of founders are still in that mindset from 10 to 20 years ago where you want to be anointed by a VC, right? It's when a term sheet comes in, that's when your business is real. But I think what you're really hearing is with the $200K you get from us, you should be hitting some real traction. You should be finding customers.
Yeah. I totally agree. Look, I don't want to put myself out of business, but look, I think that's right. Look, there is a whole set of people, and obviously, SkyDeck is one of them, but there's a whole set of people who contribute to capital at a very early stage that are well before, quite frankly, the traditional venture ecosystem comes in. And look, it's in your best interest, right? Like, quite frankly, you want to come to me as late as possible where you have kind of got something that has the traction where it's just a no-brainer for me to do it. And now look, I'll take one tangent, which is, and Sean, you and I have, I think, had a discussion. Everybody heard the term lean startup, right? Or knows lean startup? Okay, so brilliant stuff. The problem with lean startup is, the misinterpretation of lean startup was that being lean was a goal. The reality is, look, the goal has never changed. The goal is you got to win the market because, look, unless it's perfectly fine if you don't want to build a big business, but for most of you who are here, I assume you want to build something that's important, enduring, and big. And so, to me, the right time to raise capital from someone like us is, yes, you've kind of done a lot of work, you've got traction, and the risk of not raising capital is you are going to cede that market to somebody else who's going to get there before you, right? And so, yes, I totally agree with you, John, that I think capital at all these early stages are tremendously impactful, and it puts you in a situation where then, yes, when you're ready, come to us and go raise 5 million or 10 million or 20 million. Obviously, people are raising a lot of money these days, and that's totally fine. But the question on that is, does raising that capital help you win the market? And so, I would just be careful. Again, the opposite is true also, which is don't make yourself so lean that you kind of, you actually, whatever, you can, I love profitable companies, so don't misinterpret what I'm saying, but if you make yourself lean at the expense of being able to invest in the things that will enable you to win the market, at least I would argue from a venture perspective, you have, kind of done what is not in your best interest.
Very clear. Questions?
Okay, one sec. We're going to grab the mic.
Oh, okay, yes.
And we're also going to film people asking questions. So who's first?
Let's go to our founders here.
Test. Khushid Hassan, founder of Cloud Idea, a cloud infrastructure company. I have this curiosity for a long time. Trading off profitability versus SG expenses, and it shows that a lot of public companies are not profitable either. How do you think about it, especially in times to come?
So look, this has changed, right? So if we were having this conversation 5 years ago, I think everybody's advice would have been grow, grow, grow. Doesn't matter what the hell it costs. Sorry for using that term. And more growth is better than less growth, no matter what the trade-offs are. We had this hard reset, I think, in 2022, right, where basically the market all of a sudden said, that's not what we want anymore. We want, I'll make an old term that was growth at reasonable cost, right? There used to be this thing called GARP for those of you who are public market investors. So, look, I think this is an unsatisfactory answer today. I think there's two things. One is, look, the question to me is, what is the return on that investment in terms of growth? So if you go back to where I finished the last question, which is, if the goal is to win the market, I was just literally, I had a board meeting this morning and we were talking about this. I think all of us have a tolerance for spending money and being unprofitable if we believe that kind of those are investments that will help us get to winning the market. And we believe you will be able to demonstrate the appropriate milestones so that you can raise additional capital when you exhaust this capital. I think, again, what has tempered is, I think we all probably have a little bit more conservatism around that today. And so, like if you could grow, if in the past we're like, look, grow 100% no matter what you have to do and spend what you have to do, I think we'd probably all say, you know what, you grow 60 to 65% or something, and you can do that with much greater efficiency, and it doesn't dramatically kind of cut off the long tail of what your opportunity set is. I think most people would probably accept that trade-off today. So it's a hard question. I don't mean to be evasive. It's a hard question to answer exactly, but I would say like there's definitely more heightened scrutiny on it. But again, I think so, and this was I'll tell you exactly the conversation I was having with one of my companies today is they were proposing a budget for next year, and I was like, okay, like I'm all for spending, but like quite frankly, the growth you're showing for that amount of spend to me is just uninspiring, basically. So what I need to understand is like, why are we spending what we're spending, and what are those investments, and is that going to what is our degree of confidence that that's going to show up in the following year's revenue because it unlocks something we can't do. And if that's the case, this is a company that's in a reasonably good cash situation and they're not at risk of having to raise capital. Like I'm like, okay, I can see that over a 2 to 3 year period, it's a bet, but we're making a calculated bet. And if they're successful in this bet, I'm highly confident we can go raise more money at a higher valuation. Like, that's a reasonable conversation. But in the absence of that, spending, whatever, $25 million to only get, 25% growth to me for a company at that scale, feels like that may not be the best trade-off. Does that make sense?
Okay, two more fast questions. Go ahead.
Hello, Scott. Thank you for having this fireside
Oh, you have to
chat.
bring that right up to your face, yeah.
Sorry. Thank you for having this fireside chat. It was really insightful. My name is Aisha Thermador. I'm a co-founder of Aquitus AI. And my question, one of the points that I really liked was how you said that we should focus more on making technologies progress because microcycles will go up and down anyways. And I was curious on your thoughts on, what people consider the quote unquote climate crisis, if you see it as a macro cycle such as COVID or whatnot, and how you see it impacting markets and company strategies, considering COVID, it's like, oh yeah, this is not the first pandemic, there's an end to it, but I think the climate crisis doesn't have a timeline that people can refer to.
Oh no, look, I absolutely think climate is a real problem and something that is like a massive opportunity to focus on. So yeah, for sure. And I agree with you. I don't think it will be cyclical only in the sense that, there'll be times and periods where people get more excited about climate, and I don't know, maybe we'll get some data that says global warming is only, whatever, it's not progressing at the pace we thought it was, and so people might get a little less excited. But look, I agree, it's not a COVID thing, right? It's a persistent problem. And look, we have to solve it. Look, if nothing else, we have to solve it because if we're interested in AI, the first bottleneck to AI is actually energy production, basically, right? Like we can't do the things we all want to do with AI unless we actually figure out cheaper and more efficient ways to deliver energy. Once we solve that problem, like water and cooling is going to be the next problem because these data centers are going to be throwing off like ridiculous amounts of heat that has to be cooled to make sure we don't burn all the equipment. So anyways, it's a long way of saying yes, like when I say what I was intending to mean on macro was I wouldn't get too worried about the financial macro pieces. And again, because they're going to come and go. Like one thing I know for certain is we're going to have another 2018 to 2021. We're going to have another time period where we all get fat and happy and we all pay 100 times revenue for every company and we're all going to think we're brilliant. And then the market's going to change again. And we're
soon,
all
I hope. Very soon.
Yeah, and that'll be great. Look, it's fun while it lasts. And then we're all going to also get to where we were in 22 where we're like, oh my God, this is so depressing. Everything sucks. I'm never going to invest another dollar. I'm going to put my money in my mattress. And both of those are wrong, right? Like, we're never as smart as we think we are. And we're probably never as stupid as we think we are either. So that's what I'm saying. It's like I would just kind of try to not let those things swing you. To your question, right? Those things will have marginal impacts on, yes, like am I willing to lean in and spend more money or not because the funding environment can have an impact. But a big problem like climate or healthcare or government services or, I don't know, any of the million things I'm sure you guys are doing, like I would lean into all those trends.
We're going to do one from over there. I think the guy in the back had his hand up first, so. Sorry, guys.
Just make sure you put the mouth right against it. Okay. Yeah.
Hi. Can you hear me? Hi.
Yeah.
My name is Hari. For a startup, how important do you think moat is? Recently, I met an investor and he asked me, what is your moat? I replied, my product and service. He said, those cannot be a moat. So his reason was, I give all the money I have to build a product like you, or a company like you, or do the marketing or sales. So what stop you dying? So as a VC, your perspective, how important moat is for you? Like, how do you look at it?
Yeah, I don't know who that person was, so I don't want to.
It wasn't me, so it's
Be
okay.
careful. Look. Okay. Let me start with moat, right? So look, some kind of moat, or let's just use the word competitive differentiation, for lack of a better word, right? Like, yes, like in any market you go after, like, yes, you have to have some story about what it is that makes you different. And to me, moat is just like an enduring portion of competitive differentiation, right? That's all it means, which is, okay, like, because sometimes you can have competitive differentiation for a time period because you might be first to market, and then the reality is like that goes away because that's not really a moat, because maybe whatever, I don't know, you're doing something trivial from a technology perspective and everyone catches up. So the idea of a moat, which is like an enduring way for you to kind of win in the market from a competitive perspective, I absolutely agree with the question, at least, that he was asking you. I don't agree with his premise. I don't know, obviously, the company you're doing, but like, absolutely a product can be a moat, right? Like, maybe you're doing something truly innovative, or, sales and marketing can be a moat. I mean, look, God knows, like, look, Microsoft has never been known for making great products. The reality is, like, what they figured out was distribution, and we should give them credit for that. I don't even mean that to like diminish them, but like, best product doesn't always win either. Like, often best distribution beats best product, right? So I guess I don't know enough about your specific situation, but I think the idea that something like sales and marketing or product or even a team, a set of expertise couldn't be a moat, I guess I don't buy that. I don't buy that as a answer for why not to invest in you. So anyways, that's how I would think about it.
All right, guys, I'm sorry we're out of time. I promise we would get Scott out of here. One last comment.
Oh, yeah.
It is election day.
Yes.
Ben, Mark, and you have both been, all three of you have been on the record with political views. Who's going to win? I'm not going to ask who should win. Who will win, and what's going to happen in the next 6 to 12 months?
I mean, look, the honest answer is I have no idea. I have no idea. Look, I'm not trying to dodge your question. I just don't know. It's like asking me what the stock market's going to do tomorrow, right? Like, I don't know. Look, I'll just make one comment because I know we got to go. Look, Ben said this, and I agree. Look, we would rather be in a situation where we are not involved politically. I think what we came to the conclusion on was, if, in our case, again, the issues that we thought we could talk about and we care about are issues of entrepreneurship and of innovation and stuff like that. What we learned over time is if you don't have some way to represent those views among policymakers and others, there will be someone else who's going to be in their office who will represent those views for you. And maybe you agree with those, maybe you don't. And look, maybe we should all like reform our political system, which would maybe be a nice thing to do. But the reality is that's not the way our political system works. Like, our political system works of the people who show up in DC have a voice, and often people who don't have a voice, and the people who show up with checks have a voice, and the people who don't have checks don't get a voice. And again, I'm not here to defend that at all, but to say, look, I think that is the reality. So look, our view, we tried to make a very narrow view, which is, okay, like, what administration do we think would be most beneficial to further the objectives of entrepreneurship and risk-taking, which, we all believe strongly in. TBD, who's going to win? TBD, whether we'll be right. But we'll come follow up in a couple of years and see what happens.
Scott, thank you so much.